The entrance of the new Biden administration in the US, Brexit, the geopolitical position of China, and of course the economic aftermath of the pandemic with a severe impact on fleet travel and mobility. What are the global economic prospects and what do they mean for your global business? Ladies and gentlemen, William de VIJLDER, Group Chief Economist, BNP Paribas Group, will shed light on all the economic facts that can impact your global fleet management.
Hello, many thanks to the organizers of the conference. I'm very pleased to speak to you at this virtual conference on the economic outlook. I am William de VIJLDER. I'm the Group Chief Economist of BNP Paribas. The title of my presentation is Towards a Big Acceleration of Growth. It may seem striking to you that there is no conditional tense, nor is there a question mark, so that reflects that there is quite a high level of conviction in this assessment of the global economic outlook, which will be characterized by the big acceleration of growth. That is something which is visible on this slide. If you look in the rectangle, you have our quarterly forecast, that is quarter-over-quarter growth, non-annualized for major economies. We expect that in the US we will have 2.5% quarter-over-quarter growth in the second quarter, 2% in the third quarter, in the Eurozone 1.1 and 2.9. To put this better in perspective, if you analyze this, that means that US would grow something like 10% in the second quarter and another 8% in the third quarter, and Europe would move from something close to 4.5% to more than 12%. Staggering performance, which you will also observe in other countries as well. China will continue to grow fast. Japan actually also doing well, and the UK also a very strong performance. So we will see in the next several quarters a synchronized expansion of the global economy driven by the advanced economies, and that means that even towards the end of 2022, we will still be growing at a pace that will be well above the normal pace of economic growth. What is going to underpin this dynamic of the global economy? Well, it is, of course, resting on three pillars. One is the monetary support of central banks, ongoing, very accommodative monetary policy, fiscal support, think of the Biden plan, think of next generation EU and European Union, and of course the vaccination campaign, which in those parts of the world, like the European Union, where it has been lagging, is now gathering pace very quickly. This is going to underpin these three factors: final demand. That means that there will be increased activity in terms of housing construction on behalf of households. That is going to be driven predominantly by very low interest rates. Consumer spending will pick up, driven by, in the US, an improvement in the labor market, good income growth because of the fiscal support. In the European Union, the confidence of households in the labor market outlook is improving, and there's also, of course, the phenomenon of pent-up demand. What we will also see is that corporate investments will gradually pick up. That is already visible in the United States. It will lag behind in the European Union, but nevertheless it will improve based on increased capacity utilization, better profits outlook, and better demand prospects. The fiscal support I've mentioned, and then of course exporting companies will benefit from an improved outlook with their trading partners that will increase their imports. So these are really the key dynamics that are behind. What do we see today? Well, let's look at surveys among businessmen, and one of the preferred surveys is the Purchasing Manager Indices. We have converted the data from these surveys in a heat map. It's very easy to interpret. When it is red, it means it's hot, it's warm, it's a very comfortable economic temperature, it's good. And when it's dark blue, it is of course very cold, it's uncomfortable, and so on. We look at the left side of the table, that is developed markets, the right hand side is emerging countries, and we have to look at the lower end of the table, which are the most recent observations. And what you see there is that for the advanced economies, it is red across the board. So that means that it's a very supportive economic environment. It means that in the manufacturing industries, that business people have become increasingly confident. It started already in the latter part of last year, and since then it has been gathering pace. What you will also see is that even in most emerging economies, sentiment has also improved, although it has to be said, on average, it is not reaching as high a level as in the Western world. Another important point is export order assessment. So people in industry are becoming increasingly confident or optimistic about the export outlook. You see that clearly in the left part of the table, where in the advanced economies, with the exception of Greece, most other countries are in the red zone. That means very upbeat about the export order assessment. It has also improved, by the way, in the developing economies. This is a positive development. What it means is that one country is kind of helping another country. That means that there's going to be positive spillovers with domestic demand accelerating in some parts of the world. That is going to trigger more imports, is going to create more export opportunities, which then in turn will be positive for income creation, profitability in these countries. And thereby you have a kind of a circling back any mutually reinforcing dynamics. All this already has had an impact on the hiring intentions of companies. This is something which, of course, is going to be closely watched by households because households are very much interested and focused on what is the labor market outlook. What we observe there is that in the advanced economies, again, the employment outlook is improving. That means that manufacturing companies are saying that they are contemplating to increase hiring. We already see that very clearly in the US, by the way, where there have been a stellar performance in terms of job creation, but hiring intentions are on the rise. And other surveys, by the way, show that this has not gone unnoticed for households, and they have become kind of more relaxed about the labor market outlook. This is an important factor because it means that households will then be more confident to go out and spend and kind of tap into these accumulated savings that have been accumulated during the lockdown of last year. Services is a sector that is typically prone to be more sensitive to restrictions. We have seen that, of course, in the leisure industry and the tourism industry and in the trade sector as well, retail trade. And that explains why it has been lagging. If you look at the color scheme for March and April, you will see that there is less red out there than we have seen in manufacturing. But nevertheless, even there, things are improving. And we've also seen that in other recent indicator relating to services. What's interesting is that with this improvement in the economic environment and significant improvement in the economic outlook, the concerns of companies are shifting. This is a survey conducted with about 300 chief financial officers of major US companies, survey conducted by Duke University together with the Federal Reserve Bank of Cleveland. And what you observe is that the most recent survey for the first quarter, that is shown in dark blue, and compared with the previous survey in light blue, that is that the investment intentions of companies, they're still focused on replacing and repairing equipment, but I would say it's less dominant than before. What you see is that there is now more focus on increasing capacity, but also the second arrow, there's a clear focus that has increased on cost reduction. And the third arrow is also showing that there is a focus on reducing reliance on labor. And this is something that also shows up in other kind of anecdotal evidence coming from companies. That is that companies have been shell-shocked last year with the pandemic and with the hit to supply chains, and that is why they will increase their investments in automation. The European picture, how does that look like? Well, I'm showing you two spider charts from the European Commission, left industrial confidence. I invite you to look at the light blue one, this is the low point in 2020. And then we have the orange line, which is a survey for a large number of countries that you show on the screen. That is for the month of March. And then the red line is the April survey. So you see that we have already come a very long way in terms of improvement of industrial confidence in the European Union. And in a number of countries, we're very close to the dark blue line, and the dark blue line is the historical peak that we have observed. So this again confirms good news from the industrial sector for industrial confidence. What you see to the right is kind of what I've mentioned before, that is that services confidence indeed has also improved. But you will see, of course, that the distance between the red line and the dark blue line is bigger. So that means that services still have some catching up to do. That will, of course, improve significantly as in the countries that are still suffering from restrictions. These restrictions will be gradually lifted because of the successful vaccination campaign and the decline in the number of new infections. Turning to developing economies, heterogeneous picture. China will continue to grow at a healthy pace, although the peak in growth is now behind us. The peak in growth was towards the latter part of 2020. What we observe is that the focus of the authorities is also to make sure that we can grow at a good pace, but keeping an eye on financial stability risks. And that is also why they will try to rein in excessive credit growth. India is suffering, as you know, from a huge and an exponential increase of infections. The economy is holding up for the time being, but we are concerned that it would suffer inevitably from that rise in infections. Brazil is probably going to be in a recession in the first half of this year, again, against the background of a very difficult health situation. And then Turkey is doing good on growth, but is suffering from too high a level of inflation. Speaking about inflation, what do we see there? Well, again, the surveys of the purchasing managers turned into a heat map. They show you what is the assessment of input prices. That is typically the commodity prices or the price of intermediate inputs that you use as a company to produce a good. And what we see is that almost across the board, almost all countries, it's really red, and it has been red for quite some time. And that really shows you that there is a clear demand-supply imbalance, and that the opening up of economies has caused a jump in demand where supply has been struggling to follow. We've seen that with oil, we've seen that with copper, we've also seen that with, of course, semiconductors. And for instance, in Germany, companies are saying that we now have the highest level of bottlenecks since January 1991. January 1991 was right after the German unification, so you kind of see how intense the recovery is. That also means that companies are trying to reflect this increase of input prices in the prices they charge to their customers. And this is why the surveys show that output prices are also on the rise, and that is at least what companies are trying to do. You see the same phenomenon, by the way, in terms of higher input prices in services. In the US, for instance, restaurant chains like hamburgers, pizzas, and what have you are struggling to find people willing to come to work in these restaurants. Nevertheless, central banks are quite relaxed about the upside risk to inflation. So they acknowledge that for a number of reasons, the inflation rate will increase in the remainder of this year, but they also insist that this should be essentially a temporary phenomenon and that subsequently inflation would ease off again. This is what we expect for the Eurozone very clearly. And this is also kind of what the Federal Reserve is telling the markets as the message. It will be a transient phenomenon. And a key element in that respect is that, of course, inflation expectations remain very well anchored around 2%. Nevertheless, there is a bit of a question mark. What if inflation would be stubbornly high, would remain stubbornly high, and what would happen then? Well, the message from the American Central Bank is very clearly it has learned from the policy mistakes of the 70s when it did not act forcefully enough, and that meant that inflation spun out of control. And for that reason, the Fed is saying, well, if it would turn out that inflation would remain stubbornly high, that is, say, around 3% for too long a time, then of course it would be forced to tighten policy. That of course would be a concern for financial markets, for bond markets, for equity markets, and it would also mean, of course, that the cost of funding for companies would increase. That is not really our scenario. We think that the official interest rates in the US, so the federal funds rate, will stay at the current level for quite some time to come. The first rate hike at the earliest would arrive perhaps in 2023. And we also expect that the European Central Bank will stick to its policy rate for many years to come. What will happen is that both central banks will kind of adjust their quantitative easing programs as time goes by. I draw your attention to the fact that we anticipate an increase in bond yields, 10-year Treasury notes in the US. We expect them to be at 220 at the end of this year and 250 at the end of next year. For a reference, at the moment, they are around 1.60. So that means that more expensive funding conditions for governments, but also for companies, of course, inevitably. And to some degree, this will also be reflected in European yields. We expect that bond yields, 10-year German bond yields, will move to 0.20, a positive number, whereas currently it is still negative at minus 20 basis points. Exchange rate, we think that initially the euro will strengthen somewhat, somewhat, let me insist on that word, towards 123 at the end of this year. We are not that far off, I would say, and then well, next year it would ease somewhat, and the dollar would strengthen because of the anticipation by financial markets that the tone of the Federal Reserve will change to prepare markets for the tightening of policy in 2023. And then the final slide I want to share with you is the longer-term consequences of the pandemic. I think there are three elements at the company level to insist upon. One is the necessity to adapt the supply chains, to increase the resilience of the supply chains, to introduce or to kind of stick to a hybrid way of working, partly from home, partly in the office. This will require investments. Digital and automation, clearly we've seen it from the CFO survey, will also require investments, and then a big emphasis on sustainability, which will also require investments. A lot of investments, that means that a lot of demand, a lot of production that could trigger somewhat higher inflation, but investments also means increased productivity. Increased productivity will then actually push down inflation. So it means that the inflation outlook is not as clear-cut, and that means that well, monetary policy will have to adapt if necessary, should it turn out that inflation is moving trend-wise a bit higher and getting closer to the inflation objectives of the central bank. Productivity also means, to some degree, labor market disruption, and that means that governments, but also companies, will need to cope with that by, for instance, providing training possibilities for their staff so that they can get better tuned into the new needs in the labor market in a fastly evolving society towards more digital and more IT-based. And then finally, government policy will also be characterized by increased rules and incentives, probably to stimulate and to boost the sustainability agenda. So this is something that can also change the environment in which companies will be working. On the one hand, we have the investment drive coming from governments. On the other hand, rules can also mean companies will need to adapt. And with that, I'm going to finish here. I thank you for your attention and wish you a good conference. Thank you.
Thank you, William de VIJLDER from BNP Paribas Group, for this comprehensive economic outlook.